Let's bring in Larry Shover, Chief Investment Officer over at SFG Alternatives in Chicago. Larry, wonderful to see you on the program. Now, take us through what you make of these moves, because obviously talk around OPEC, this unscheduled surprise meeting potentially happening at the end of next month. Initially, we saw a bit of a bounce in those oil prices, but I mean, that sort of seems like the market's quickly moved on to focus back on these oversupply issues.
Yeah, it's really interesting to see what's going to happen. But what's even more interesting is the low level of volatility that news or any news with oil is producing in other markets around us. So either people just are unconscious to it all, or they just feel like it's not worthy to be on the front page of the newspaper anymore. I think the bottom line is that people realize that we're in an oversupply situation, that the market can become balanced by the end of the year, but that doesn't necessarily mean that oil has to go up in price. I still believe that we're going to see oil prices in the mid-40s by the end of this year, but there's going to be a lot of put and takes, and this surprise meeting or unscheduled meeting is just one of those.
Now, you've been watching these WTI spec shorts, I note. We've seen them rising pretty sharply over the past 2 months or so. Take us through these moves, what it means, I guess, longer term, where or what sort of suggestion that is for oil prices going forward.
You know, I think when you look at managed money and how they're placing their money, whether they're long the market or short the market, it kind of helps reiterate a view somebody already has. And you're exactly correct. WTI speculative shorts have been near, if not at, an all-time record for a while. That definitely, looking at history, is not enough to make me or anybody to be bullish on oil, but it's definitely something that we have to look at and take seriously. What it does do, though, is that when you have an enormous amount of longs or shorts in the market for hedging purposes or speculation purposes, when the market changes direction, when we see a whipsaw, it's going to be fast and furious because you have so many people scrambling to get out of the positions that they previously have put on.
All right, let's talk the broader market, because we know that oil obviously has been a key driver, but with the market sort of hovering around these record levels, the S&P just pulling back towards the end of the session there, the NASDAQ, a new record all-time high. A lot of it, I mean, being driven by central banks and this cheap money, obviously, at the moment. But what do you put it down to? What do you think is underpinning this performance in equities at the moment?
Yeah, I think it's the same old story. There's this desperate search for yield anywhere you can find it, and people really almost not looking at multiples or fundamentals, just looking for that yield. And since the dog days of summer began on July 14th, I mean, we have been wobbling around near all-time highs, but basically moving sideways. People are very confident with that $130 earnings per share for 2017. And what we've seen in the last month is just a rotation out of safety stocks into cyclicals. And one way you can look at that is the NASDAQ has outperformed the S&P 500 by 2% over the last month. That's still not a trend in my mind, but basically it's been sturdy for the past 3 or 4 weeks anyway. So that's what's going on, out of safety into growth and cyclicals.
I mean, we've been watching the VIX index, this volatility at the moment, sort of fluctuating, but trading around its lowest levels in a year. And off the back of that, obviously, high levels for equities, although it has been in a relatively tight trading range. Do you think the path of least resistance is higher from here? What are the chances that we can sort of break above that 2200 mark, for example?
Yeah, no, it's a great point. I mean, it's so complex right now because I think just so many people are very comfortable with their investment portfolio, not realizing that they're looking at or they're actually buying equities with bond-like profiles with a multiple that we haven't seen before, haven't seen for a long time. And so when you have like implied volatility so low, it's complacent. We have bonds trading in a very tight range. I'm afraid this isn't going to end well, but it could last. It could basically trend a lot longer than most of us would gather, but I don't think it's going to end well.
How are you allocating your portfolio at the moment? Have you shifted it much in light of these record highs at the moment? Are you taking a bit more of a cautious view of putting money into bonds or safe haven assets? Take us through that asset allocation.
Yeah. So at the beginning of July, I did go underweight U.S. equities, and I haven't been underweight since 2007. First time I actually went underweight, severely underweight equities. I still think the money right now is income. If you have to be in equities, it's defensive, and that's basically what everybody else is getting out of. I'm kind of rotating where everybody else is rotating out of. I do like gold right now just because of the uncertainty of the central banks. It's probably the first time I've said that all year. I mean, I think everybody should have gold in their portfolio, but given the sell-off that we've had, a good time to get in as part of your portfolio. I would up my allocation to alpha, and that would be managed futures or global macro, just given the uncertainties and the low levels of volatility that we're seeing around the world.
Why would you not be outright long stocks?
Well, when it comes to the equity market, like I said, I do like the defensives. That would be the utilities, the REITs, et cetera. That would be in the U.S. I mean, I think the cyclical story, it could go on for a while, a lot longer than I think, but I don't want to get caught in the middle of it. I still like Japan. I still like Europe. I still like the U.K., just like I did from the very start of the year. Hasn't been the best call, but keep in mind that at the beginning of the year, I said I liked those issues on a unhedged basis. So cyclicals outside the U.S., I'm plenty fine with. The emerging markets, great, just like from the beginning of the year. The only change I've had is in the U.S., where I did go underweight at the very beginning of July.